The past few years have been turbulent ones for Europe. The euro was tested by financial markets for the first time since its introduction. And for the first time in recent economic history, Europe performed the worst compared to all other world regions. The two successive recessions of 2009 and 2012-13 took their toll. In several EU countries, especially in Southern and Western Europe, gross domestic product is still lower than it was in 2007 before the crisis started. The good news is the monetary union did not collapse. The euro retained its value against the US dollar, and the weakest eurozone countries were bailed out with the help of Europe's two small monetary funds, EFSF and ESM, also referred to as the bailout mechanisms. Now, what is the outlook for 2014? In Austria, most important leading indicators are signaling economic recovery. This trend is driven mainly by rising demand in key export markets, especially in Germany and the USA. By Austrian standards, the situation on the labor market is tense. Never have there been so many people unemployed. Wage increases are therefore hardly to be expected. This is why consumption will not develop very strongly in Austria and why inflation will remain low. In contrast to the last few years, however, investment activity will pick up. This is expected because investments were sluggish in 2012 and 2013. For 2014 and 15, GDP is expected to grow by 1.5 to 1.8% in Austria per year. The economies in Central and Eastern Europe are also facing better economic prospects. The CE countries are open economies with lower GDP per capita levels. They respond faster and more markedly to economic fluctuations in their main export markets. The upward trend started in the second half of 2013 and will continue in 2014 and 2015. In most countries of Central and Eastern Europe, the forecasts estimate growth rates between 1.7 and 3% per year. The highest growth rates are expected in Romania and Slovakia. Close on their heels are Hungary and the Czech Republic. Croatia, however, will stagnate in 2014 and will start expanding again only as of 2015. Economic growth in the CE region will gain a broader base in the coming years. On top of its exports, Central and Eastern Europe will also benefit from expanding domestic demand, that is, from higher consumption and investments. The reasons behind this trend in most countries are a more optimistic sentiment, stabilizing labor markets and slightly rising incomes. Furthermore, those countries which joined the EU in 2004 and 2007 are now in a better position to tap into EU's structural and regional funds. A remaining downside risk is the escalating conflict between Russia and the West over Ukraine. Any mutual economic sanctions or a steep increase in energy prices could substantially hinder economic recovery in Europe.